A company that produces goods and services is commonly known as a firm. In the United States, firms are classified as sole proprietorships, partnerships, corporations, or limited liability companies. LLCs are a newer type of business organization used in the 1990s. An LLC is a form of business ownership that combines elements of both corporations and partnerships. It is not a corporation or partnership, though it may be referred to as a limited liability corporation, though the correct term is limited liability company. The owners of an LLC are known as members, not shareholders or partners, and there is no limit to the number of members, which can include individuals, corporations, or other limited liability companies. Objectives of firm. Assuming that a company's goal is to maximize profits, profits are calculated by subtracting the total cost of producing the product from the total revenue received from selling the product. Total revenue is determined by multiplying the price per unit by the quantity sold at that price. In a competitive market, the increase in revenue from selling one more product unit is equal to the cost. In conclusion, a company's objective is to maximize profits, and costs play a critical role in determining the profit margin. By comprehending the different types of expenses and their relationships to the quantity produced, a company can make informed decisions on maximizing profits while minimizing costs. Total cost. Total cost is the sum of fixed costs and variable costs of production, including all costs such as salaries, rent, material costs, business permits, etc. All opportunity costs should also be included in total costs. In the short run, at least one input is fixed, while other inputs are allowed to vary. In the long run, all capital and labor inputs can change. Marginal cost is the change in total cost resulting from a 1 unit change in quantity produced. Analytical cost concepts. Average total cost is the total cost of production divided by the quantity produced, also known as the cost per unit. Average variable cost is the sum of all variable costs of production divided by the quantity produced. Average fixed cost is the sum of all fixed costs of production divided by the quantity produced. The cost data presented in the table shows that fixed costs remain constant regardless of the quantity produced, while average fixed cost continuously declines as quantity increases. Average variable cost and total cost decline and then increase as production increases. Analytical cost concepts. Marginal cost is the change in total cost resulting from a 1 unit change in quantity produced. Marginal cost also decreases when quantity is low and then increases as quantity increases. Once rising marginal cost, average total cost, or average variable cost is experienced in the short run, the company will continue to see that cost rise as quantity keeps increasing and will not go back down.